The purpose of this video is to address some of the misconceptions that I've seen on many YouTube videos recently addressing the various cost of living crises around the world, stemming primarily from the COVID pandemic and the invasion of the Ukraine. I also wanted to deal with some of the misunderstandings which proliferate about the nature of money when related to governments which issue their own sovereign fiat currency. And those governments include the USA, the UK, Japan, China, India, etc. And just to clarify the terms, sovereign fiat currency is currency issued by a single national governmental authority whose value is floating, i.e. not linked to any commodity such as gold or any other currencies. The standard definition of money is that it's a storage of value and a medium of exchange. These definitions are not incorrect, but they are insufficient given that almost anything can be a storage of value and a means of exchange if you swap it for other goods and services. Two additional characteristics are needed in order to correctly define money, and these are that firstly, money is a tax credit, and secondly, it's an infinitely transferable IOU whose acceptance is mandated by the issuing authority and whose creation is limited by the same authority. The earliest examples of taxation that we know of was a tax paid with grains and crops in 3000 BC Egypt, and the payment of taxes with goods and services was predominant for centuries after that. Money acts as a tax credit in lieu of goods and services, which is accepted by the issuing authority and relieves the payer of their tax liability and any resulting loss of property or liberty due to non-payment. But the fundamental nature of money is that it is an IOU, or in other words, a record of debt owed in goods and services. If you possess a $10 bill, then that is an IOU that you can exchange for $10 worth of goods and services. Let's look at this in a little more detail with a practical example. There's no evidence that any human societies or markets throughout our history have functioned using a barter system. But this is just a hypothetical example to illustrate a point. Let's imagine that you bake great pies and I bake great bread. I want your pies and you want my bread. So the first thing we need to do is agree on a value equivalence so that we can begin to trade. Let's say we agree that one of your pies is worth 2 of my loaves of bread. So we start trading. One day I tell you I want a pie, but there's a problem. You do want 2 loaves of my bread, but not for a couple of weeks because you're going away on vacation. So you want the bread freshly made when you get back. Our agreed solution is that you bake the pie and give it to me now, and in return I write out an IOU for 2 loaves of bread, which you can redeem from me when you return from vacation. The IOU's not payment. It's just a written record of a debt owed, i.e. 2 loaves of bread owed for 1 pie already supplied. In the real world, you'd have obvious concerns about this solution. Can I be trusted? What if my business closes down? What if I get run over by a bus, etc.? You can't use the IOU anywhere else, so you're taking a risk by accepting my personal IOU. Wouldn't it be great if we had some kind of transferable IOU that you could use at any other place of business for any goods and services whenever you need them? That way you wouldn't be carrying all the risk of me being untrustworthy or something happening to me. It would also make trading so much easier for all other consumers and suppliers. The transferable IOU would still not be payment in and of itself. It would still be just a written record of a debt owed. So you don't actually get paid for your pie until you convert the transferable IOU to goods and services from me or any other business. We'd need some kind of issuing authority to mandate the acceptance of the IOUs and to limit their supply so we don't have more IOUs in circulation than the goods and services we produce can handle. Let's use the government for that, especially given that there is meant to be no distinction between the people, quote unquote, and the government, inasmuch as a democratically elected government is supposed to be of the people, by the people, for the people. Essentially, the government is us, all of us, and the IOUs that it issues have to be honoured by all its citizens. The IOUs have no inherent value. Their value lies solely in the goods and services that they can be exchanged for. So the issuing authority, and all consumers and suppliers, would have a vested interest in limiting their supply so that the integrity of the economic system is not compromised, and that the recipients of the IOUs can have reasonable belief that the amount of goods and services they can exchange them for today will be much the same tomorrow. We can't denominate the IOUs in loaves or pies, as that's much too specific. We'd need some kind of intermediary denomination that would allow us to easily make value equivalences for all goods and services. Let's just make a denomination up. Let's call them dollars, or pounds, or yen, or whatever. We could say that one pie is worth $1,000, so 2 loaves are worth the same and work from there. However, let's keep the numbers more manageable and say that one pie is worth $20, and so are 2 loaves. Therefore, when I give you the $20 note for your pie, you can exchange it for $20 worth of goods and services anywhere else you wish. This means that everyone else in our economic sphere has agreed to pay my debts for me whenever required to, just as I have agreed to pay their debts when someone presents money to me in exchange for my bread. This exchange mechanism also works well for facilitating trade between providers of goods and providers of services. If you are, let's say, a civil engineer, your skill set and time have a value to some people, but not to your local grocery store. So even if we were to agree on a value equivalence, let's say 4 hours of your time and expertise as a civil engineer equals 1 week's worth of grocery shopping, it's going to be difficult for you to get groceries from the store because your particular skill set is of no value to them. With money, your employer can give you IOUs to an equal value as 1 week's worth of groceries. Remember, they aren't really paying you. They are issuing debt to you, which is a record of the fact that you provided them with 4 hours of your work, but they didn't provide you with any goods or services in return, just a certain value of IOUs. So, it's the grocery store which is really paying you for your 4 hours of civil engineering work, just as someone else will pay for your groceries when the store uses the same IOUs to pay for goods and services they need. So, to recap, the government can create as many IOUs, or money, as it wants to, because it can create money from nothing. But making that money supply proportionate to the value of goods and services available is essential to the integrity of the economic system that allows trade to happen. We all think that when we receive money in return for goods and services that we've been paid, but we haven't. All we have received is a written record of the debt resulting from the fact that we have provided goods and services to someone but have not received any goods and services in return. We don't really get paid until we convert the money to other goods and services, and they are limited in availability by labour and resources. And just as a side note, Bitcoin and other cryptocurrencies match up to the definition of being storages of value and a means of exchange, but they are not tax credits, nor are they mandated transferable IOUs, and that's why they'll never really be money and why their value is so volatile. Now let's use a different analogy to look at money creation, taxation, and other ways we can bestow value on money. Imagine a father who has some number of children. The kids don't do any work to tidy their rooms or hoover or wash the dishes or mow the lawn. The father sits the kids down and tells them that this work won't do itself, so they need to start doing it. He shows them a list of the jobs to be done and tells them he's going to pay them for their work with his personal business cards. 1 card for tidying their bedroom, 2 cards for washing the dishes, 3 for mowing the lawn, and so on. He puts the list up in the kitchen and leaves it at that. A couple of weeks go by, and the father realizes that nothing has changed. No work has been done by the kids. So he sits them down again and asks why they haven't complied with his instruction. The kids say, "But Dad, your business cards are worthless. We can't use them for anything. Nobody wants or needs them. we'd just be working for nothing. The father thinks about this for a minute and then says, okay, from now on, you don't have to do any work at all. It's entirely up to you. However, I'm going to start taxing you 30 of my business cards per month. So, at the end of each month, for every card you fall short of the 30 due in taxes, you lose a day's freedom. No having friends over, no music, no TV, no electronics, and you're confined to your room. Naturally, the kids don't want to pay that penalty, so they start doing the work and receiving cards in payment. The father has, for all practical purposes, an unlimited number of business cards, and clearly he has to dispense cards to his kids in payment before he can tax them back. Common sense tells us that the father can't tax his cards back from the kids until he's given some to them in the first place. So we can see from the start that the father has to spend his cards in order to tax them. He can't and doesn't tax in order to spend. So the kids start to earn cards, and at the end of the month they each hand over 30 of them to their father in tax payments, so they don't have to suffer any of the penalties. You, and no doubt the kids, might wonder why the father needs to get 30 cards back in taxes from his kids each month if he already has an infinite number of cards. The answer is because if he doesn't, then the kids will accrue cards over time, and they'll have the 30 cards they earned 6 months ago, plus the 37 they earned 5 months ago, and so on. And very soon, they'll have so many cards that they'll lose value, inasmuch as they'll no longer need to work to earn them. No kid is going to wash the dishes for 2 cards if they already have 150 cards saved up. In effect, if the father didn't actually take possession of the 30 tax cards at the end of each month, then the kids could use the same 30 cards every time to pay their taxes, and they wouldn't need to do any more work. The father needs to control the number of cards in circulation so that they retain their value. And by that, I mean that the kids have to do work each month in order to earn more cards to pay their next lot of taxes. This is one of, if not the, primary purposes of taxation. It's to destroy wealth, so that the amount of money in the economy can be maintained at a level where it is not disproportionate to the value of goods and services supplied by that economy. Let's imagine that this system is working so well that the father decides to extend it. From now on, the kids will pay for their lodging, food, clothes, laundry, etc. with the business cards. The father doesn't intend this as a punishment, so for that reason he increases the amount of pay for each task so that the kids can earn enough cards to not only pay their taxes, but also enough to afford to buy all the things they need and at least some of the things they want. Remember that the father can pay as much for each job as he wants, given that he has an unlimited number of business cards. He just has to make sure that there aren't so many cards in circulation that they start to lose value. Let's go a little further. Suppose the father introduces automatic card payments to any kids who are sick or injured, or because at any given time all the jobs that needed to be done have been done, or because they need unforeseen medicine or healthcare. This is necessary to ensure that each child can get food, clothes, and other essentials because the father cares about his kids' well-being. If any of the children complain that one child is receiving more of these types of payments than the others, and that the father should not be spending their tax cards in such a way, then the father can point out that he isn't spending their tax cards. He doesn't need their cards in order to have cards to spend. He already has an unlimited number of them. Their tax cards are being destroyed. They're not being used to pay sick kids. We've been conditioned our whole lives to think of deficit spending as bad, as a negative, particularly for the national government. This example should have made it clear that government deficit spending is not only a good thing, it's essential. Government deficit spending is simply the money that the government puts into the economy but doesn't tax back out. If the father didn't put more of his cards into the economy than he taxed back out, then the kids wouldn't have any cards to buy food or clothes or medicine. All the money you and I have ever earned, saved or spent in our lives, or ever will earn, save or spend, is there because of government deficit spending, because without that there would be no money in the economy. So many people now present government deficit as being so-called debt. In what sense is it debt? Who is it owed to? It's nonsensical to call it debt, as we can see in the analogy of the father and his kids. When the father pays his kids more cards for the work they do than he taxes back from them, he's deficit spending, but he isn't in debt to anyone. He can put as many cards as he likes into the economy because he has an unlimited amount of them, and if he doesn't deficit spend, then his kids won't have any money. And to address another silly misconception, obviously he doesn't need to ask China if he can borrow some of his own business cards from them. He already has an unlimited number of his own. I imagine some of you will be saying that the government debt is to bondholders. That's who they owe the money to. Well, not really, not in any normal meaning of the word debt as it applies to me and you. Federal bonds and securities are an anachronistic carryover from the days of the gold standard, when new money creation was limited by the value of gold reserves held by the government. Then, bonds were a way for the federal government to remove money from the economy temporarily without using taxation. Money invested in bonds was considered to be off the books until they reached maturity, and that gave the government leeway to create new money and spend it into the economy for any purpose it saw fit to. Nowadays, their primary purpose is to give a guaranteed minimum income to wealthy investors. The Federal Reserve, and any other central bank, is the government's bank, and account holders are private banks and global governmental entities, including foreign countries. The Fed has two types of account: reserve accounts, which are the same as a current account for you and me, and securities accounts, which are the same as a savings account. When reserve account holders want to invest their money into US Treasury securities, they buy bonds, T-bills, etc. All that really means, in effect, is that the money they invest moves from their reserve account into their securities account. If it wished to, the US government could eliminate all of its so-called debt overnight, simply by removing all money from their customers' securities accounts and putting it back into their respective reserve accounts. But so what? What difference would that make? This is where the myth of Chinese debt comes from. The USA buys more stuff from China than China buys from the USA, so naturally China acquires more and more dollars in their Federal Reserve account. Instead of leaving the money to sit there doing nothing, they buy US securities, just as you might move excess money from your current account to earn a little bit more interest in a savings account. When the bonds reach maturity, the money is moved back into their reserve account from their securities account, and that's it. Debt repaid. Given that the US government can create as many US dollars as it wants, then it's impossible for them to run out of money and default on bond commitments unless by choice. The idea that we have a credit card with the Bank of China on which we're racking up debt for our kids to repay is just pure nonsense. This graph details US government spending from 1951 to 2012 and divides the economy into three sectors: 1, government; 2, private domestic; and 3, private foreign. As you can see, both sides of the graph are mirror images of each other because, like all macroeconomic systems, the most basic rule is that one person's dollar of expenditure must be another person's dollar of income. Every time the US government spends a dollar, it's a dollar of income for someone in the domestic or foreign private sector. And every time the US government takes a dollar out of the economy in tax, that's a dollar of expenditure for someone in the domestic or foreign private sector. Local taxes do fund local government, however, because they are essentially the same as you and me in that they need revenue to fund expenditure. Taxes can also be used to encourage or discourage certain types of behaviour, such as by taxing carbon emissions, smoking, alcohol, imports, etc. Taxing at the upper income levels is particularly important on moral grounds to maintain reasonable wealth distribution parameters. In the developed world, the wealthiest individuals and corporations pay little or no tax, which has seen income disparity levels which have not been witnessed for over a century, and which are completely unsustainable economically and completely unjustifiable morally. So, wealth disparity puts enormous political power and influence into the hands of a tiny number of people and allows them to fund lobbyists, pressure groups, and political parties. Let's get back to the father for a moment. He's become a little fed up with carrying business cards around with him, so he decides to just use a ledger. When one of the kids does the washing up, he just writes a number 2 next to the child's name in the ledger. At the end of each month, he tots up their totals and then deducts 30 from each for the taxes. He doesn't even need to carry or destroy cards anymore. He simply writes a number on the paper. That's payment. And a little later he rubs that number out, and that's tax. Hopefully this makes it even clearer that any notion of the cards having real value, or that the father needs to get cards back from his kids in order to be able to make payments, is nonsensical. In the modern world, that's how most of us receive and spend money. On payday, we go to our computers for online banking and we see that the number in our bank account has gone up by the amount we get paid. Then we pay our credit card bill by deducting numbers from that account. Then we pay our taxes the same way. At no time did any of that money ever exist other than in the form of digits on the computer screen. If you could hack into your bank's computer system, you could go to your account, let's say currently with a 0 balance, type in the number 10,000, hit enter, and there you go. You'd have $10,000 where there was nothing before, and that money would be every bit as real and existent as if someone had given you $10,000 in cash. Where did it come from? Nowhere. If they catch you and deduct the $10,000 from your account, where did it go to? Nowhere. It is a literal impossibility for any government which issues its own sovereign fiat currency to ever run out of that currency. Taxes are irrelevant to the creation of money at that level. The only limiting factor is controlling inflation. So, using the USA as our example, the US government, and by government I mean the executive and legislative branches combined, can never run out of US dollars. It can afford to buy anything that's for sale in US dollars at any time that it chooses. It can afford to fund any spending program that it chooses to, whether that be Medicare for all, high-speed cross-country train system, green technologies, military expansion, aid to Ukraine, COVID payouts, bank bailouts, or anything else. The purpose of the spending is a political decision, but the spending is limited only by the need to maintain acceptable levels of inflation. If you find this hard to believe, then listen to Ben Bernanke, then chairman of the Federal Reserve, talking in 2009 in response to a question about whether all the money pumped into the financial system as a result of the 2008 crash was taxpayers' money.
That second week of October, the Dow fell 18%, its worst week in history. In the midst of the crisis, Bernanke had freedom to act immediately. He doesn't need prior permission from Congress or the president. While they debated on Capitol Hill, Bernanke cut interest rates nearly to zero. Then he used Depression-era emergency powers to launch a dozen rescue programs of his own. There was support for money market funds, mortgages, short-term lending to small businesses, and support for auto loans, student loans, and small business loans. Commitments of $1 trillion, doubling the size of the Fed's balance sheet.
Is that tax money that the Fed is spending?
It's not tax money. The banks have accounts with the Fed much the same way that you have an account in a commercial bank. So to lend to a bank, we simply use the computer to mark up the size of the account that they have with the Fed. So it's much more akin, although not exactly the same, but it's much more akin to printing money than it is to borrowing.
You've been printing money.
Well, effectively, and we need to do that because our economy is very weak and inflation is very low. When the economy begins to recover, that'll be the time that we need to unwind those programs, raise interest rates, reduce the money supply, and make sure that we have a recovery that does not involve inflation.
And that's how it works. The federal or national government creates and spends money by typing numbers into a computer and hitting enter. The people that run the machinery are telling you how it works. You just have to listen. This is an explanation of how things actually do run now and have done for many decades. So, why do we hear so much from politicians that government spending has to be funded by taxes when it's clearly not true? The answer is that the rules of the economic game change depending upon who you are. When the people at the top of the power pyramid need money to be created to finance a war, to bail out financial institutions, to purchase their worthless toxic assets, it's done, no problem. But if anyone suggests Medicare for all, or better unemployment insurance, or proper NHS funding, or a decent old age pension, then all of a sudden money cannot be created. That type of expenditure requires funding from taxes, and you don't want your taxes to go up, do you? If you make a broad distinction between the top 0.5% of the population by wealth and the remaining 99.5% of us, then as far as inflation is concerned, what happens in the world of the top 0.5% is of little importance. No matter how much money you have, you can't eat 1 million restaurant meals all in the same evening, and you're not going to buy 1 million toasters or TVs or washing machines at the same time, even though you could. In that world, the only inflation concerns are with the price of super yachts or penthouses in Monaco. If you decided that pumping $2 trillion into the bottom 99.5% of the US economy was going to cause unacceptable inflation, then that's all there is to it. Whether you get the $2 trillion from a wealth tax or from creating new money, it isn't going to change the inflationary impact. So, whilst a wealth tax on the richest corporations and people is absolutely justifiable and necessary for previously stated reasons, it's irrelevant with respect to public expenditure. We are seeing high levels of inflation across the developed world now, but this is not because the bottom 99.5% have too much money. On the contrary, many people don't have enough money to afford basic necessities, even if they're wage earners. So taking more money off them by increasing taxes is entirely the wrong thing to do. It's true that government and central banks around the globe have indulged in an orgy of spending since the 2008 crash, but a large proportion of that has gone to the top 0.5%, resulting in, as I say, wealth disparity far, far greater than has been seen since the end of the Second World War. The result is that a tiny number of individuals own controlling interests in all the world's largest corporations through equity asset management firms such as BlackRock, State Street, and Vanguard. In practice, this means that the CEOs and boards of the largest energy, aviation, pharmaceutical, tech, food, freight corporations, etc. in the world all report to the same bosses. So there's absolutely no desire for price competition. The inflation we're experiencing now is virtually all stemming from the supply side of the economy, not the demand side. So, to wind up and make a final recap, money is just a concept. It's an intermediary valuation system that has no inherent value of its own, just a derived value from the fact that it can be exchanged for things that really do exist and really do have inherent value, goods and services. I hope my video promotes some thought and debate, and comments below are welcome.